Hi, this is Jeff Brailio, and welcome to our LLC education series. This video is on LLC taxation and doing an S election for some tax savings. Just part of our series so that you understand your LLC. So before we get started on how LLCs are taxed, just remember that today's presentation is copyrighted and there's no need to steal it because it's free online at any time. Just go to our website and you can watch the video. This video is for educational and informative purposes only. It is not financial, accounting, or legal advice. So please call our office if you have any questions particular to your situation, and we're happy to advise you then. But this is just for education so that you are a more aware business owner and more likely to be successful. A little bit about me. Again, attorney for 20 years, created lots of businesses, worked with lots of clients, and been in the business for a very, very long time. There's a little bit more about me, and you've probably seen or heard a lot of that. And our office, we do entity formation and asset protection, estate planning, title and escrow, business and real estate transactional documents, consulting, fiduciary services, and lots of education like the video you're watching right now. We have live education courses in classrooms, and we do free webinars at least once a month that you can jump on and join us for some great information. Okay, taxes and S elections. LLC actually never pays taxes. The LLC itself, that is, never pays taxes. The taxes are paid by the owners of the LLC. But an LLC can be taxed three different ways. First, it can be taxed like a sole proprietor. This means the LLC does not file a tax return. All the income and expenses get accounted for on schedules on your personal 1040 tax return. And these are single member LLCs. So only a single member LLC can opt to be taxed as a sole proprietor and not have to file a tax return. As we've mentioned many times, there are advantages to multiple member LLCs, specifically asset protection. And so generally we only set up single member LLCs for tax saving purposes. This would be sort of the S-elected LLCs for real estate commissions and other active income that don't run a lot of liability, and they're basically set up for tax purposes, tax savings purposes. But just remember that if you have a single member LLC, it does not file a tax return. Similarly, if an LLC is owned 100% by another LLC or by a family limited partnership or by a family trust, then that LLC does not file a tax return because, again, it only has one member. Even though that member is not a human, it is still a single member LLC, and all the income and expenses will flow through onto the owners, meaning that LLC or family limited partnership or family trust, onto that tax return. Okay, so that's the great thing about a single member LLC is that there's no tax return. But it doesn't come with some of the great liability protection, asset protections of the multiple member LLCs. Okay, an LLC can be taxed as a partnership. So any multiple member LLC will be at least a partnership or maybe an S corp taxed. If it's a multi-member LLC, by default, it will be taxed like a partnership. It will file a partnership tax return, and the LLC will issue K-1 statements to each member. Okay, so in this case, you will need to file a tax return, and your accountant will charge you for this tax return. It's usually not expensive. Most accountants in the state of Utah are $250 to $300 for a pretty straightforward partnership tax return in K-1s. And a K-1 is really a statement that says what percentage of the net gain or net loss of the LLC is attributable to that member. And then that member will take that K-1, either tax gain or tax loss, and report it on his or her personal 1040 tax return. So again, the LLC doesn't pay a tax here, but it must file an informational tax return and tell the IRS which members are responsible for which gains and losses. Okay, now this does mean you're going to pay your accountant to do a tax return, but it is worth it. It's a very small cost for the added asset protection of having multiple members. So again, we always recommend multiple members, but again, understand and be aware that you will file a partnership tax return. Or it can be taxed like an S Corp. Any LLC can make an election to be taxed as an S Corp. The letter S comes from Subchapter S of the United States Tax Code, you know, that big set of documents that govern our taxes. But Subchapter S allows for some tax savings, which we're going to talk about in a minute. And you must do an election. So this does not come automatically. If you're a single member LLC, by default, you're going to be taxed as a sole proprietor. If you have multiple members, by default, you're going to be taxed as a partnership. So if you want this special election to be taxed like an S Corp, you must make the election with the IRS. You must fill out a short little form, sign it, and send it into the IRS. It's free. You just send it in and you tell the IRS that you want this LLC to be taxed under Subchapter S of the tax code, and it will then be taxed like an S Corp. And it's very common to kind of confuse S Corp and S elected LLCs. Previously, many years ago, LLCs could not make this election. And so the only way to be taxed under Subchapter S of the tax code was to have an actual corporation, an Inc. And so we would set up an Inc. and then do this election, and that Inc. would be taxed like an S Corp, and that's where the name comes from, S Corps. And that's the word that everybody kind of knows and understands. Oh, yeah, I have an S Corp, or I'm supposed to set up an S Corp, and et cetera. But now LLCs can make the same election. So in 95% of the cases, we will set up an LLC and then elect that LLC to be taxed like an S Corp. So that might be a little confusing, but just understand, for your purposes, you have an LLC. You have members, you have managers, you treat it like any other LLC. It's just that for your accounting and tax purposes at the IRS, you are taxed like an S Corp. Okay? Remember, you must make that election. You can make that election at any time. It does not have to be when you form the company. It's generally advisable at the beginning of a year, but it can be done mid-year. So just kind of be aware of that. It's usually dependent on the income you're generating. We'll talk about that in a minute. But again, you must file that form, send it to the IRS, and then the IRS will send you a letter back stating that they have accepted the election and you are now to be taxed like an S Corp. Once you do make that election, there are restrictions on switching back. So kind of be aware of that. It's usually a couple of years before you can switch back. We always recommend you discuss this with your accountant, and we are happy to have that conversation with your accountant as well so that we are all on the same page and we're doing the right thing in your particular situation. So it is a decision that you'll need to make in consult with your attorney and your accountant. Okay, but filing that S election can save you on taxes, and that's what we're going to talk about here. We recommend making this S election on all entities that are generating active income due to the tax savings under Subchapter S of the tax code. What is active income? Active income is income generated by an active pursuit that is regularly engaged in for profit. Pretty much everything that you do will probably be active income. We'll give lots of examples. If you're just a small business owner, you print t-shirts, you do wedding planning, you have a hot dog stand on the corner, these are all going to be active income pursuits. They're businesses, and you act like any business, and you're actively engaged in it. You have to do marketing and sales, and maybe have a storefront, and pay sales tax and order goods and services and supplies. These are active pursuits, and therefore they are active income. The one exception for most of our clients is rental properties. Rental properties are passive income. And so we never recommend holding a rental property in a company that is S elected. Not only because there's no tax savings, because it's already passive income, and there can be issues about transferring that property out of an S elected LLC, and it may be deemed a taxable event. So for our real estate clients, be very, very aware of this. Never put a rental property, a long-term hold, into an S elected entity. For our real estate clients, we will set up an S-elected company for their active income pursuits, and we will set up a separate LLC, like a series LLC, for their long-term hold. So they are separate companies. So be very aware of that. When to elect? Like I said, you can do it the day you start the company. You can do it at the beginning of your next tax year. You can do it pretty much any time. We generally recommend, once you're netting, I should say, $15,000, $20,000, $25,000 in income, there are definite tax savings. Even if you're making $10,000 in profit, there are still tax savings to be had. It generally depends on you and your accountant and what you're comfortable claiming as salary and dividend, and depending on how much you make, and et cetera. So you do want a good accountant who understands S-elections and how to save you on taxes with the S-elected entity. But you can do it at any time. So if you start a company and you don't think you're going to make a lot of money for the first year, that's great. You can just wait until the next year when you think you're going to make more money and do the S-election then. But again, you must fill out that form and send it to the IRS and get the letter back. Okay, how do you save? You save because the income can be divided between dividend and salary. If you don't do the S-election, all of that active income that you're making in this company is considered salary. Salary is taxed at a higher rate than dividends. And so without the S-election, 100% of that net gain, 100% of your profits, is considered salary and subject to the higher tax. If you do an S-election, you can take that money and divide it between dividend, call some of it dividend, and call some of it salary. The salary portion is still subject to the higher tax, but the dividend portion is not. It's subject to a lower tax. So you can save on part of the money that you're making in this company. The downside to doing an S-election is, yes, all S-elected companies must do a tax return, even single member LLCs. So if you're a single member LLC and you have not been doing a tax return, once you do this S-election, you will have to start doing an S-corp tax return, and you should do payroll because the money you're taking out is classified as either dividend or salary. So you should put yourself on a payroll to pay yourself the salary portion. We usually don't recommend this the first year you set up an S-elected company. You can just kind of take money out, and your accountant at the end of the year will just kind of do a separation and divide it up, call some of it dividend, call some of it salary, and issue the right tax forms for that. But generally after the first year and after you file your first tax return, we do recommend a payroll. It is not expensive and it can be super easy. And we have lots of referrals that we can help you out with that. So just give us a call and we'll give you the referrals for payroll companies. Literally, it takes me 3 seconds to do a payroll. I just send an email to my payroll company telling them how much to pay me, and they do it. They automatically withdraw money out of my business account. They take out all the taxes. They send those taxes to the IRS. They pay unemployment and other obligations, and then they take the net and they automatically deposit it into my personal account. And literally it's done. It takes me 3 seconds, and in one day I've done payroll. And it's in my personal bank account. So super easy and really inexpensive. It is probably the cheapest service that I ever pay for in my business. So just be aware of that. Okay, so how do you save on taxes? On active income, you are subject to 3 levels of taxes. The self-employment taxes, or SE taxes, federal income taxes, and state income taxes. Okay, now we do have a 1-hour video course called Real Estate as a Business. We talk about a lot of real estate stuff, but in that 1-hour video, we do talk in length about self-employment taxes, federal income taxes, state income taxes. So it's a much longer version of what you're watching right now. So feel free to watch that for more explanation. There's nothing we can do about federal income and state income taxes. But like I said, we can save money on those self-employment taxes with an S-elected company. So how does that work? What are these self-employment taxes? Well, it's Social Security and Medicare. If you ever worked for an employer and you got a W-2 wage and you got your pay stub, and there were those little boxes, FICA, Medicare, Medicaid, Social Security, and there were withholdings. And you probably remember your employer telling you that you pay half and the employer pays half. Okay, well, now that you're self-employed, you're both the employer and the employee, so you pay both halves. The total tax is 15.3%. And there's some variation on that, and if you make over $200,000, it goes up a little bit, et cetera. So, but to keep it simple, it's 15.3%. So if you don't do an S election, you're going to pay that 15% on every dime you make because it's all active income. If you set up an S elected company, then the portion that you call dividend is not subject to this 15%. So you save 15% off the portion that you call dividend. So let's look at some examples. In this first, there's two examples on this page. One, you're netting $30,000, so you made $30,000 in profit. And the other example, you made $100,000 in profit. So here is just your self-employment tax. On the $30,000, you paid $4,500 in just self-employment tax. And if you netted $100,000, you paid $15,000 just in this self-employment tax. And there's no way around that. You will pay that full amount. Then your business income gets put onto your personal tax return, and you get your personal deductions and all that, and you figure out your federal and state income tax at your tax bracket. So you add those on. But you're paying a minimum, even if you can have personal deductions to erase all of that, you're still paying that self-employment tax on all of it. So what we're going to do now is do an S election and see how these numbers change. If we do the S election, we can call some of it wages, active income that is subject to the self-employment tax, and we can call the others dividend, which is passive income and not subject to the self-employment tax. Okay, here are two examples again. We're going to do an S election split, call some of it salary, some of it dividend. And in the first example, we're going to call $20,000 salary and $10,000 dividend. Okay, and in that sense, we're only paying the self-employment tax on $20,000, not the full 30. So our self-employment tax is a little over $3,000. We just saved $1,500. And that's just the first year. You will save that year after year after year. So you saved $1,500 simply by filing this S election with the IRS. Now let's look at our $100,000 example. Previously, we had to pay $15,000 in self-employment tax. And in this situation, we're going to call $40,000 salary and $60,000 dividend. Okay, our self-employment tax now, because we're only paying self-employment tax on the $40,000, not the full $100,000. Our self-employment tax is only $6,100. We just saved over $9,000 in taxes. And then again, that is year after year after year. And the more money you make, the more you can actually save. So again, this S election that you can do on your LLC, if you're making active income, again, don't think rental properties, that's separate. But on your active income, such as a small business, real estate commissions, flipping and wholesaling, if you're a contractor, that's all active income. And you can save by doing an S election and save quite a bit. Now, what do we call salary and what do we call dividend? What does the IRS say about this? How much do we have to take in salary? You know, because you're probably thinking, well, good grief, I'll take 100% or 95% as a dividend and pay no self-employment taxes. Well, the IRS requires that you pay yourself a reasonable salary. And that's all they said. If you're audited, the IRS is going to ask, is the amount that you claimed as salary reasonable for what you did and where you did it? It will look at where you live, what common incomes are for what you're doing, what you might have to pay somebody else to do what you're doing. They'll look at how much money you need to live off of, and and if you're not paying yourself enough to live off of, then you're really not paying yourself a reasonable salary. So there's a long list of things that the IRS will look at. Generally, we leave that up to our clients and their accountants. Accountants are great at this. They see lots of tax returns. They see lots of income levels. They see lots of S-elected companies, and they know how to kind of adjust things. Some accountants are more aggressive than others, and that's a decision you'll have to make. But again, what you'll have to do in an audit is argue that, yes, the amount that you paid in salary was reasonable. Okay, so you do got to pay yourself something. And as long as it's reasonable, you're good. And like I said, in this example, $40,000 a year income in the state of Utah is actually a pretty good income. So that to me is fairly reasonable. Okay. If you have any more questions about a nested elected entity, we have certainly lots more educational videos on our video education page, or you can call us at 801-560-2180. Thanks for watching, and just get in touch with us if you need anything.